Okay. Now, today we'll be starting one of the most important chapters in audit and in your syllabus practically as well. It is like one of the most important areas that is and that needs to be covered, right? Um, when we talk about substantive procedures, right? I already told you guys earlier that substantive analytical procedures and substantive test of details. These are two categories of substantive procedures, right? Substantive analytical procedures we saw earlier, okay? Substantive test of details we'll be looking at in this chapter. So our objective for today is to cover substantive TODs. Now, when we looked at TOCs, test of controls earlier, we looked at different cycles, we looked at different processes, we looked at different, and obviously a document, for example, let's talk about a source document, for example, an invoice, right? An invoice is generated because of a business transaction, right? So for example, let's say I sold goods on credit to a customer, right? And I generated an invoice which I issued to the customer, and it was on credit, so obviously he will probably pay me after 1 or 2 months. Make sense? The point is that as a result, a source document, which is invoice, was generated from our company, within our company, right? And let's say the sales department generates it, or it basically let's say sends a direction to the finance department. The finance department raises an invoice and records it, right? And as soon as the goods have been dispatched, obviously it's not our responsibility now. The risks and rewards related to those goods have been transferred to the customer now. Okay, so we will de-recognize those that particular item of inventory from our SOFP, and we'll record the cost that we basically incurred to make that sale, which is basically cost of sales, right? Now the point is that when we do this transaction, right, there are certain elements that are being hit in your accounting books, in your statement of financial position or statement of comprehensive income, right? If you look at the revenue side, let's forget the cost side right now. Let's look at the revenue side only. When we look at the revenue side, you have on your debit, because it's a credit sale, you have receivables, right? And on your credit, you have revenue, right? Now, this could either be bank or receivables depending on your type of sale. Right now, we're considering that it's a credit sale. Okay. The point is, when this is parked into your accounts, when it's recorded into your accounts, right? The process through which the invoice, a source document, travels to your financial statements was, and the robustness of that process, the effectiveness of that process, the efficiency of that process was basically tested as a part of TOC, right? So it was a part of test of controls. Why? Because there are certain controls that come into play when you talk about a source document traveling all the way to your top line of the SOCI. Okay, because it's not just one invoice we're talking about over here, right? Let's say there are millions of invoices generated in a year, right? Thousands of invoices generated in a year. Okay, so when obviously each invoice, even one invoice, if it goes, let's say, you know, if it's a hoax invoice, or if it's misstated, or if it's not recorded correctly, let's say there's an error of omission, error of transposition, for example, 89 is written as 98, right? That's an error of transposition. So anything can happen, right? Because obviously there's involvement of both human and machines, so anything can happen. We make sure as an auditor that the processes that the company has implemented, or the controls that the company has implemented as a result, or to ensure that no error is basically errors could happen, they either detected and corrected, or they're prevented altogether, right? So the point is, in that case, We need to, and we discussed earlier as well, that we assess the control effectiveness, which is basically test of controls, right? Right now, what we're talking about is vouching, the balance, getting there, getting to the balance, getting to the figure that the management claims. Number one, the management has reported. Number two, the management claims that this is the right value. This is free of material misstatement. This value, each and every value. Because when they talk about the overall financial statements, what they actually mean is each and every value, right? Because obviously financial statements is nothing without revenue, cost of sales, assets, liabilities, capital, right? So it's nothing without that. So what they technically claim is that each and every value is free from material misstatement, and we need to vouch their claim. We need to verify their claim. Okay, because ultimately shareholders rely on our opinion, not on management's opinion, not on management's claim, not on management's opinion, right? They basically rely on our opinion as auditors, as external auditors. Okay, so for example, let's talk about, one of the figures in your um, in this double entry. Let's say receivables, right? And I'll give you examples as well. So you want to figure out whether the balance that, or whether the ledger balance or the trial balance figure or the balance sheet figure for receivables is correct or not, right? Now, correct or free from material misstatement does not only mean mathematical accuracy. It does not only mean relates to the company. It does not only mean relates to the period in which it's reported, right? The point is that everything comes into play in every assertion, and not every assertion, basically assertions related to your account balances come into play when we talk about receivables. And assertions related to classes of transaction come into play when we talk about the credit side of this, because it's revenue, right? It's a class of transaction. It's not an account balance. Make sense?
So,
Guys, does it make sense?
yes, sir.
Now, let's just quickly, before I start this topic, let's just quickly review the assertions. Okay. Completeness is valid for everything. It is valid for classes of transaction. It is valid for account balance, and it is valid for events. Okay, events, or basically what you report in disclosure, for example, right? So it's valid for everything. Okay. Now the point is, completeness means what? That your accounts are complete, your records are complete. Occurrence, valid for transactions and events, classes of transactions and events, right? Valuation is valid for account balances. Existence is valid for account balances. Rights and obligations valid for account balances. Accuracy valid for account balances and transaction events. Classification presentation obviously is valid for all these things, because everything is being classified, and we claim, and the management claims that everything is classified in the correct account and presented thereon correctly, right? Cutoff valid for transaction events, for example, revenue. And allocation is valid for account balances, right? So there are technically one, two, three assertions that are valid for all of them, right? Which is completeness, classification, presentation, and accuracy. Okay. So the point is that you have to, and you should know what assertions are being hit and what you want to test, because ultimately we are here to verify management's claims, and assertions are management claims. Okay, you understand this? Now, the point is, one way to assess or one way to verify it is through the systems that the management is using to record such transactions. But again, that does not verify the assertions related to numbers. That verifies the overall process, the how robust the process is, right? When we talk about procedures, we say that you test the balances, you test the transactions, the class of transactions, or you test the events, the numerics of the events. right? The numbers of the events. How is the event reported? All right. Now, all right. Now there's a balance over here that you have, which is bank and cash, right? The best way to vouch, to verify a bank balance is through a bank confirmation letter. And you, if you remember, I told you earlier as well, bank confirmation letter and through bank reconciliations, right? An external bank confirmation letter. You send a bank confirmation to the banks. They respond with the balance that the company has deposited with them, any advances given to them by the bank, any loans given to them by the bank, any liens, charges on the account balance, any overdrafts taken by the bank. All these things are reported in a bank confirmation. And there are cases where the bank confirmation tells us more than what the company is willing to tell us. And there are cases where the company does not, where the client does not, it doesn't want us to send a bank confirmation. Okay? Because they're trying to hide stuff. All right. So bank confirmation letter is a very important document. Bank reconciliations, you all know from your F7 and F3 studies, right? Not in F7, but in F3, you studied bank reconciliations, right? You perform bank reconciliations to make sure the client obviously performs. It's their job to perform bank reconciliations to make sure that the bank balance ties with the cash book. Okay. But the point is, the difference is whether they're investigated or not. That is what we are concerned about. Okay, because the differences cannot stay on forever. And one more thing, when I talk about bank, I remember this happening with once there was a case where the bank confirmation came in, right, and the figure was big. The figure that the company recorded was different from what was stated on the bank confirmation. And the bank statement of that account vouched for what the company recorded. Okay. So basically, the banker who filled in that statement, or who filled in that letter, confirmation letter, made an error of transposition. So numbers were, swapped. So third digit was swapped with the first digit and stuff like that. Okay. So the bank confirmation was revised. So it's not like you take in a bank confirmation, you put in your file and you go home. You need to cross check, you need to corroborate with other evidences as well. Okay. Bank reconciliation, you have a bank balance and you have a cash book. The only thing there is the reconciling items. And reconciling items, and I'm just telling you right now, reconciling items are tested as well. How? They're tested for subsequent clearances and subsequent deposits, because we're working for ASAT, right? So if a company does not have a history of, I remember there was a client that had 63 reconciling items, 63 unpresented checks. I won't even say reconciling items, 63 unpresented checks. All right. And when inquired, and there were a lot of checks out of 63, I believe there were 25 or 20, I don't remember the figure, it was 3 years back, but I guess it was around 25 or 28 checks that were stale checks. And the company had still recorded them, right? They were stale checks. Stale checks means that a check was expired, so it was more than 6 months old. You cannot excise a check if it's more than 6 months old. Okay. So the point is that they were stale checks. And the one who was preparing it, the one who was reviewing it, the one who was signing it off, they were least concerned about it. So we had to remove it, right? We asked them to remove it. So the point is that stuff like this happens, but again, you need to keep your eyes open as an auditor. You need to be very skeptic, and you need to exercise your professional judgment as well. All right. Now, there's one more thing with regards to the cash that we perform is the cash count. Obviously, we cannot go into a bank and ask them to bring out, $10 million so that we can count it. We perform a cash count of the petty cash as at. What's a petty cash? Do you guys know what a petty cash is? Have you guys heard about petty cash?
Yes.
Right? Harsha, are you part of an audit firm, or you're part of, you're on the client side,
Client side.
industry? So you're
Yeah.
in the industry. Which industry are you in?
Retail, but
Sorry?
doing accounts. Yeah.
Which industry are you in?
Retail, sir.
Retail.
Yeah.
That means you have a lot of cash coming in and going out, right?
Yeah.
Yeah. So you would probably know better that auditors, if you guys do your, if you have auditors, I don't think, do you guys have auditors?
Yes. We have
All right.
internal audits also.
All right. So internal auditors
Yeah.
also perform the same procedures that external auditors do. All right. So the point is that there is a cash count at each month end, or external auditors do it at year end, right? So as at 30th, let's say 30th June or 31st December, right? So the point is that when you perform a cash count um, on the petty cash, we get to know what the cash balance is exactly at that date, which will be reported into your financial statements. All right. So there's an impress system as well. You guys have impress system?
Yes.
Right? So impressed, usually what you do is, so let's say there's a thousand amount, petty cash can go up to maximum 1,000 rupees, for example, $1,000, for example, right? And then you at every $200 you will reimburse the balance. So the difference turns out to be 800, right? So each time you cannot go above $1,000 in cash and not below $200 in cash, right? So let's say right now they have $400 available. So all I'll do is I'll take the $400 and I'll reconcile it to $1,000. So the expense vouchers and stuff like that, I'll reconcile and get to the figure. All right. So this is what auditors do. Now, non-current liabilities is also an account balance, right? There are various ways of vouching or verifying the non-current liability balance, right? You need to inspect bank information letters for any loans. I just told you that. Bank information letters of security over assets, which is also called liens or charges, right? I told you that as well. Financial statements for disclosures of interest rates, because obviously when you're calculating your FC, which is your finance cost, that needs to be on the same interest rate that is being reported. Make sense? Cannot be different, right? Recalculation, very important. Split between current and non-current liabilities. And let's say if you have a convertible loan note or a convertible debt, right, Harsha and Divya? Okay.
Yes.
So what do? You need to recalculate the equity portion compared to the liability portion. Okay. Inspect cash book for loan repayments made. Obtain breakdown of all loans outstanding at year end. Do you guys understand these procedures?
Yes, sir.
You sure? Guys, you understand this?
Yes, sir.
All right.
Yes, sir.
Just a second. What I want you to tell me is that obviously you cannot just go in and inspect documents, inspect, for example, bank information letters and stuff like that. Obviously you need a figure to vouch, right? You need a figure to vouch. So the first thing that these are generic procedures that I've written down for you guys. All right, these are generic procedures. So you can, let's say it's easy for you to memorize and then you can write down, or you can use them, not write down, not as it is, you can use them in your answers. The point is, when I talk about non-current liabilities, right? So the first thing, remember one thing, when you have an account balance, the first thing that you always do is get the breakdown, right? So obtain the breakdown, number one, and check mathematical accuracy. Make sense? You ask for the breakdown and you check the mathematical accuracy. All right. Now, what you have to do is that when I talk about obtaining a breakdown and checking mathematical accuracy in an exam question, right? You'll have to reflect in your answer as to what assertion or what you're trying to obtain from this. What assertion are you trying to verify from this? Okay, you'll have to verify this, or you'll have to basically tell that in your answer, right? So let's just quickly, I just for testing concepts, and that this is the reason I wanted to revise the previous section of assertions. Can you just tell me, uh, let's say procedure number 3, financial statements for disclosures of interest rates. What assertion do you think will you satisfy through this? What assertion do you think you will satisfy through this? Can you guys tell me? One procedure can satisfy 2 or more assertions as well, right? So in this case, financial statement disclosure. So it's talking about disclosure, right? So you're talking about basically presentation, not classification, because classification does not come into play over here. But yes, you're talking about presentation. Similarly, let's say recalculate split between current and non-current liabilities. So this probably talks about allocation. Yes, this talks about what? You studied classification as well, right? Classification presentation. So classification, right? So allocation and classification, right? So let's say the last one, obtain breakdown of all loans outstanding at year end. And obviously I've mentioned the next part of it is as well, check mathematical accuracy. What would you obtain from this? Completeness. The skill over here is to make sure that you can vouch, or you can verify, or you can basically correlate your procedure with the assertion. Forming a procedure is very simple, it's not that difficult. The point is, what are you trying to achieve from it? Okay, what are you trying to achieve from it? All right, you guys get it?
Yes, sir.
Now, non-current assets. So you have intangible, which is IS 38, right? And you have other assets as well, right? Which are tangible assets. Okay. What do you think you'll achieve through this? Or what procedures do you think you can perform? So for a non-current asset or for an intangible asset, what would you like to know? the closing balance, whether it ties or not. So let's start with the opening balance. So I know a schedule of opening balances. So basically what you would want is the fixed asset register, right? Then additions to the assets, disposals, depreciation. In intangible case, it's amortization. So for depreciation, you would want to know, obviously for additions, you would want to know date of addition so that you can allocate the depreciation. Similarly for disposal, then you would want to know gain or loss on disposal, right? You have depreciation, you would want to know the rate or the method. You can also, and you will also recalculate the depreciation. All right. Similarly, you can have your impairment charges, right? As per IS 36. So that impairment, obviously it's an expense, but again, will hit your non-current assets, right? Similarly, if you talk about impairment, you can talk about revaluations, upward or downward, assess methodology for revaluation, right? Whether an external valuer was hired or not. Okay. So these could be all the areas that you would want to target in a non-current asset area, related to non-current assets. Make sense? When we talk about specifically intangible assets, right? You guys remember the development criteria? Research is basic. Research is an expense, you expense it out. But you remember the development criteria as per IS 38, right? You will talk about, or you will have to verify each one of those, right? The technical feasibility of completing the intangible asset, intentionality, availability, adequate technical, financial, and other resources, and the cost of the asset should be reliably measured, right? So these areas, obviously you cannot have generic procedures for all of them, but yes, when it comes in an exam question, you can obviously TODs, like I told you earlier as well, TODs basically fall in the ambit of inspecting documents, obtaining evidence that will satisfy your um you know what do you call that, that will basically satisfy you with regards to the value that is being reported, with regards to the transaction that took place, with regards to the disclosure that was given in the financial statements. Does it make sense, guys? Does it make sense?
Yes.
Yes, sir.
All right. Now, as for the amortization, it's the same as depreciation. You recalculate it, you inspect the forecast and the budget so that obviously you can verify how long will the asset last, right? And you inspect whether the rates and the depreciation expense has been adequately disclosed in the financial statements or not. All right. Remember one thing, when you have this is also a procedure, by the way, what I'm about to tell you. You obtain draft financial statements from the management to ensure that adequate procedures have been, or adequate, not procedures, adequate disclosures or presentation has been uh, given to the particular number. Make sense? Because if you haven't given adequate disclosures, there's no use, mentioning revenue is $100 million. How did you get $100 million? Where did you get it from? That is what the disclosure will contain, right? And for users of financial statements, again, disclosure is important to the extent, and only to the extent, where the information is useful for them to take a financial decision, to take an investment decision. All right, not beyond that. Yes, there are, because annual reports are disclosed, or they basically for a listed company, annual statements are disclosed, annual financial statements are disclosed to the bourse, right? To on the exchange, so and on your website, and all through different publications. So the point is that everyone in the public has access to it. You don't want to disclose discrete information that will probably, uh, destroy your competitive advantage. There are certain secrets to the business, right? How do you think Tesla ended up having such a huge valuation in such a short time? There has to be a reason behind it. They have a secret sauce, right? And that secret sauce is Elon Musk. And the company is so dependent on his brain and his innovations. Whenever he brings in a revelation, whenever he brings in a news, he tweets, anything good, stock prices shoot. All right. So the point is that there has to be, and this should corroborate your information. The reason I'm telling you this is because this should corroborate your information that you're giving out in financial statements. All right. Because otherwise this will come into the ambit of exploiting the share price, right? And then obviously we talk about management integrity and stuff like this. Get it?
Yes, sir.
Now, inventory. The thing I told you earlier as well, when I was teaching TOCs, right? I will not tell you the exact procedures because that will shut your brain. The only thing that your brain will signal you is to rectify stuff from the notes. Okay, so procedures in TOCs, there you cannot just rectify them. You need to think. Okay, inventory has two major variables to it as per IS2. You have the cost structure, you have the cost, and you have the, what's the second one, guys? What is the second one? Hello.
Yes, sir.
What's the second one? NRV. All right, net realizable value. Okay, what you have to understand is that when we talk about inventories, right? So that this part is all theoretical, right? But when we talk about inventories, remember one thing, and not just inventories, anything, right? What is the balance, or what is the transaction made of? That is what you have to verify. So let's say in inventory you have cost and you have NRE. Cost is made up of units into unit cost, right? So number of units into unit cost. And NRV is made up of selling price less cost to sell into number of units, for example, right? Inventory is recorded at lower of. All right. So what you have to understand in this case is that number of units into unit cost, NRV, which is selling price less cost to sell, into number of units. Again, within these, you have number of units to verify, which you do through what? One of the ways to do is through physical
Yes.
inventory counts. Unit cost could be verified through what? Through breakup or schedule of, let's say, purchases, or you can say supplier statements, right? You can recalculate unit cost by looking at the taxes, right? Obtaining the tax schedule that is basically implemented on the, or basically what do you call that? It's basically tax allocated per unit on that product, right? So you can do all these things. The point is, again, procedure is an act. It's an action that you take to verify the balance. All right. So schedule of purchases from or supplier statements, right? Taxes, production costs, right? Whatever your standard cost is. Remember standard costing? So you work out the variance, you calculate the variance, you obtain the variances from the client, and then you recalculate the variances. You inspect the reasons for variances. Is there, if there's any abnormality, you ask the client why there's an abnormality and how it has been treated, right? So you look at the standard cost card, for example, or the standard costs, right? You inspect that, okay? And what else there could be? Number of units, you have your inventory sheet for inspection, right? Remember one thing, that physical inventory counts is not our job as an auditor, all right? It's the job of the management, right? But unfortunately, in the practical scenario, we end up doing it. That's why we hate this job so much, all right? Get it? Now, there's one more small thing that I would like to discuss since we're talking about inventory only. There are certain cases where your inventory is held at a third party warehouse. It's held by a third party, right? So let's say inventory. How do you think you'll verify this type of inventory? And again, guys, one thing, when we talk about inventory, it's an account balance. So all the assertions apply. In exam question, I'll tell you how to link the assertions with the procedure. And obviously I'll tell you more procedures as well, so that you can open up your mind. Okay. Now, what I want you to tell me is, what procedures can I apply when, if there's a third party warehouse in which my inventory is being held? First and foremost, as an auditor, I'm talking about, you will get confirmations. External confirmations are very important. When you talk about a supplier, external confirmation. You talk about a receivable, external confirmation, right? When we talk about a loan given out to employee by the company, employee confirmation. Confirmations are very important. Okay. So these are just procedures, guys. These are not what you'll achieve from it. External confirmation by third party, which is obviously you'll obtain external confirmation by third party, is a procedure. What do you think you'll achieve through it? Or what would be the extension of this procedure? Will you just receive the external confirmation and file it? No. In an exam question, what you need to write is what you'll perform in a practical scenario. You cannot just obtain an external confirmation by third party and file it in your working papers or with your working papers. You cannot do that. What good is that confirmation if you don't want to complete the procedure? Which would be, the completion would be that you compare it with the inventory schedule you've obtained from the client. And if there are any discrepancies, remember you cannot let go any discrepancy. Any discrepancy or variation is inquired upon. You need to ask the client, why is there a discrepancy? Why is there a variance? All right. So variance and discrepancies are always inquired upon, and that is something that you need to write, because in a practical scenario you will do that. Okay. So external confirmation by third party. All right, and you can say corroborate or compare it with inventory obtained from client, full stop, inquire any variances to ensure. Now when I say to ensure, this is where I tell you, or this is where I tell the examiner, what am I trying to achieve? To ensure, because obviously I cannot talk about existence, because inventory does not exist at my premises. That is not my warehouse, so I cannot say existence, right? To ensure rights and whether the records are complete. Now this is one complete procedure that you'll have to write in your exam. This is one complete procedure. It talks about first step, second step, and what you're trying to achieve with these steps. Make sense? Guys, Sheena, Harsha?
Yes, sir.
Yes, sir is no good for me. You have any questions, you ask me. All right? And I want you to have questions, because I'm not that good, honestly. Okay? Now, do you have any questions? Is there a scenario building up in your head, something like that? I want you to ask questions. You never ask questions. Guys, do you have any questions? No. Again, no is not a good answer. I want questions. I want to test my knowledge as well. All right. Okay, now that's one thing, right? Once you have talked about and look at the you know, the sequence that I'm forming. Once you know that the inventory does exist but not at our premises, right? This will also ensure that whatever exists, we have right to it, right? So this will also ensure that the inventory exists at the third party warehouse. You have to put yourself in the situation. You have to make sure that you are pretending to be an auditor when you come across a transaction. Okay. This will ensure that the inventory exists at the third party warehouse to which the client. Okay. So it could be both ways. You can write this statement, you can write this statement, both will be correct. Okay. Now, Continuous and perpetual inventory systems, you guys know what this is, right? Do you guys know what continuous and perpetual or perpetual inventory systems are? I already told you uh, in I guess TOCs, right? Internal controls, okay, or probably earlier, right? Now the point is there are some advantages and disadvantages of perpetual counts, right? And we have come across this scenario in our exam, in our kit questions as well, in our practice questions as well, right? The question that we did in the last class, it had a perpetual inventory system, correct? So this is just theory. I want you to read this and ask if you have any questions. Receivables. What are receivables? Money that you're owed. A money, a right to receive cash, basically, right? A right to receive cash. Now there's an ISA, and I've already talked about external confirmation. So I'll just ISA 505. So this standard talks about external confirmations, right? Confirmations that you send out to suppliers or your customers is also called circularization, right? So circularization, right? So what you want to know is basically the balance that we have recorded should be the same as the company or the customer has on its accounts. Okay, you understand this? Preparing the external confirmation is auditor's job. Remember this. It is our job to prepare the confirmation. It is our job to there's one procedure that I'll tell you what we do is circularization of receivables and payables, right? This is done on company's letterhead. Circularization of receivables and payables, this is done on company's letterhead. But bank confirmation is sent on firm's letterhead. Bank confirmation is sent on firm's letterhead. All right, you guys get it?
Yes, sir.
Okay. Now, when I talk about circularization, there are two types of approaches to it. There's a negative circularization and there is a positive circularization. All right. Positive is something that I'll discuss first. Positive is a more reliable source of information. Why? Because we expect the receivable or the supplier, that is a payable, to mention the balance that they have in their books for us, all right, related to our company. Whatever balance for receivable, they'll have a payable balance against our name. Why? Because if it's a receivable for us, we're a payable for them, right? Similarly, for a payable, right, they'll have a receivable balance against us. So we ask them to confirm the balance. All right, we ask them to confirm the balance if there's any discrepancy that is investigated by the management, right? Whereas in the negative case, in the negative circularization, what you do is, which is also called a negative confirmation, what you do is you mention your balance. So let's say we obviously we don't write you, we write the company's name that they relate to. This is a summary of what we basically write. Okay, this is a summary of what we write. So what we're trying to say over here is that we basically in a positive confirmation we don't write our balance. We just ask them for their balance and the differences are investigated, right? But in a negative confirmation, what we do is we write down our balance and then we ask them to respond only if they think that the balance is not correct. Okay, that is what negative confirmation or negative circularization is. Get it?
That's
This is the main difference. You sure?
sure, sir.
Okay. Now, you have prepayments, right? The sum paid for goods or services before the receipt or invoice due date. Very simple. You guys know what prepayments are, right? There's certain procedures for it, which are self-explanatory. What I want you to do is obviously at the end of the class, I want you to revise them. Okay, go through with them. Payables and accruals, again, the opposite of prepayments, right? So you can use this. Just a second, guys. Second. All right, now payables you have to attain or obtain a list of trade payables to verify accuracy. Obviously, verification of accuracy is done through casting. Remember one thing. Now, this is a term that is not used anywhere. You don't get to use it a lot, and you'll probably not come across this word a lot. But casting means adding together. All right. So casting means that you add the balances, you add the numbers to verify mathematical accuracy. And this is the first thing that we do in our audit. Whenever we get a any ledger, right? Any ledger we talk about, what we do is we manually cast it on a calculator. All right. So casting is something that is a procedure. This procedure will be useless in another 2-3 years, but for now it's useful to check mathematical accuracy. All right. Obtain supplier statements, investigate and reconcile the items, which I already told you earlier. Reconcile total of the individual payables accounts with the control account. Very important. This is a very important procedure because in individual payables accounts, the total of that should match your control accounts. All right. Inspect after date payments. That means after year end. Okay. Inspect invoices received after the end of the year to ensure no further items need to be accrued. So if you're receiving invoices after this happens sometimes, customer might send you a late invoice, whereas the goods have been received earlier. So let's say the invoice time is usually 2 days or 3 days, but due to some issue, the customer or the supplier couldn't send you the invoice. Sorry, the supplier couldn't send you the invoice, and you received it after 10 days, for example, right? And obviously, if you haven't received the invoice, you won't book a payable, right? Because you don't know the amount. So you check subsequent receipts of invoices against which you already received the goods before or at year end, and you book an accrued liability. Okay, you book a payable. Make sense? Inspect payables ledgers for any debit balances. What are debit balances on a payables ledger? That means your payable owes you money, right? So payable becomes a receivable. This could be a case where there is probably a discrepancy or a credit note or a debit note was raised, right? And let's say you have recorded on the debit side of the payables, right? So you will set it off against your remaining payables balance. Okay. For example, in the next year, you purchase some more amount and you might settle off against future payables balance. Okay. Obtain list of accruals from the client, identify missing items for or unusual fluctuations. Obviously, this is very important because you need to investigate. Investigate means inspect or inquire as to why there were unusual fluctuations in the accruals, what new took place in the current year. Recalculate sample of accrued costs by reference to payment schedules and contracts, right? So you need to remember that for example, your rent agreement, right? So if you already have the agreement, you can easily recalculate right? Because it's according to the agreement. Inspect invoices received to confirm the actual amount and assess whether the accrual is reasonable. Again, reasonableness testing of estimations, because accrual is an estimation, right? So when we talk about estimations, we talk about reasonableness testing. Make sense? Provisions and accounting estimates. All right, I want you guys to read this. Make sure you understand it. If there's anything you don't understand, you can ask, because these are most important. These are very important. You have a special standard on it, right, which basically talks about special considerations related to accounting estimates. That is one thing, and then you have its own auditing standard, right? Auditing accounting estimates, right? But the point, this is again, like I said, it's very important. But what you need to look at is whether you understand these procedures or not. When you talk about share capital can be, number one, you have your articles of association, you have all the legal documents, right? So it tells you what let's say you have a share certificate, right? You can inspect a share certificate, which states the par value, right? Articles also states the par value, right? And then you can ask, and this is a very valid procedure, board minutes to verify the share capital amount. So how much should be shown as the ordinary share capital, right? Remember, board minutes inspection is a very critical procedure in most of the cases. All right, board minutes, inspection, or obtain and inspect. All right. Directors' emoluments. What are emoluments? This remuneration. Obviously, you need to assess whether the directors' uh, payments, the directors' salaries, shares, and stuff like that. Everything needs to be vouched, right? And how? As per their contract. So the most valid source is directors' contracts, right? You have to directly jump to the most valid source. That is why, and that is what will make you or will help you obtain SAI, sufficient appropriate audit evidence. All right. So directors contract. All right. Within the reserves, you obviously have dividends as well, right? So when you talk about dividends, what type of procedures are required? Obviously, one of the most crucial procedures is again the board minutes, right? Does it make sense?
Yes.
You sure? Okay. Now, statement profit and loss. Now, this is very crucial. This is very crucial, right? When we talk about statement profit and loss, there are certain assertions that do not apply as compared to your account balances. Okay, so existence does not apply, rights and obligations does not apply, right? So you have to talk about, let's say, cutoff. Okay, one of the assertions that apply on this accuracy applies on both of them, right? You remember. So let's say first let's talk about payroll, right? When you talk about payroll, what you again, guys, remember one thing: when there are a lot of numbers involved, right, and when there are a lot of estimations within the numbers involved, and when there are um, a lot of numerical volume of data, you always will do some kind of recalculation, right? And what we used to technically do was we used to basically have this is, let's say, salary expense. You want to vouch the salary expense. The first thing that we used to do was recalculation. How? So incoming employees, right? Outgoing employees, you deduct the outgoing employee salary, you add the incoming employee salary, right? And those salaries which relate to the employees who have been constant throughout the year. All right. You get that figure, you add any increments, bonuses, and any other kind of payments made to the employees. For example, incentives and stuff like that. For sales, you have commissions, incentives, right? You add it up and you get your salary expense. Obviously, you will not get the exact figure because we're recalculating. We're basically, performing an estimate type of working. But the point is, if it's close to what expense has been booked, perfect. If not, we look at the discrepancies. Why there's a discrepancy? We need to look into it. All right. So you get the point. And obviously, salary has the increment element as well, right? There could be some employees who got increment of more than, let's say the average increment throughout the period or for the current year was, let's say, 10%, and they got an increment around 18 to 20%. Why? A big why. You inspect the files, you inspect board approval or senior management approval for this unusual kind of increments. All right. So the point is, again, everything needs to have a basis, and that basis needs to be verified by us, the auditors. All right, you get it. All taxes, whether they're being, because obviously in most of the countries you have employee tax, you have taxes on on salaries, right? And it's the company's responsibility to pay it because it's a withholding tax. All right, when you study F6, you'll know it's a withholding tax on salary, right? So it's the company's job, it's the client's job to pay the tax on employee's behalf, right? So you check the tax slips, you check the tax payments against employee's salary, tax slips, or let's say tax challans, right? You check these to ensure that company is actually paying the tax on behalf of employees, and it's not the funds are not being misappropriated. Get it?
Yes.
You understand it?
Yes, sir.
Revenue is, again, it's not that difficult. Revenue is pretty simple, right? Revenue is simple, right? No. Read the elements of revenues. Read the elements for revenues. Any issues, guys? Any issues?
No, sir. No, sir.
All right. Now this is your reading material as your homework before you come to next class on Monday. And on Monday we will do kit for audit procedures. All right. So audit small entities and audit for NFPs, not for profit organizations. All right. So it's all theoretical. Okay, it's all theoretical and you hardly get tested on it. There's a very low chance of being tested, but again, it's not like I'm not saying it's not important. It's important, but to a lesser extent. All right. So I want you guys to just have knowledge regarding this. So do the reading with respect to audit for not-for-profit organization, audit of smaller entities, right? And if you have any issues, obviously you can drop in a text message. Okay.
Yes, sir.
You don't have any questions whatsoever regarding this lecture?